Welcome to our channel. Today we're diving into the Worldcom Scandal, one of the most unbelievable and outrageous corporate fraud in history. Imagine a company, once valued at over $180 billion, defrauding investors of $11 billion and ultimately leading to its bankruptcy. How did they pull it off? Who was behind it? And how did they get caught? Join us as we uncover the shocking details of this scandal that will leave you on the edge of your seat, in disbelief, and asking yourself if such a thing could happen again, and is it happening right now? The company was founded in 1983 by Bernard Ebbers, a former high school basketball coach, and Bill Fields, a former long-distance operator. Starting as a small long-distance reseller, Worldcom quickly expanded its reach through a series of strategic acquisitions, including the purchase of MCI Communications in 1998, which made Worldcom the second largest long-distance provider in the United States. The acquisition of MCI was a turning point for Worldcom, as it gave the company access to a vast network of customers and the resources to take on the big players in the telecommunications industry. Worldcom's growth was fueled by the explosion of the internet and the growing demand for data services. The company's aggressive expansion and strong financial performance made it a darling of Wall Street, and its stock price soared. Under the leadership of Ebbers, Worldcom became one of the most valued companies in the world, with a market capitalization of over $180 billion. Worldcom's success was not only reflected in its financial performance, but also in its reputation as a leader in the telecommunications industry. The company was widely respected for its innovative business strategies and its commitment to customer service. In the late 1990s, Worldcom was riding high. The company was growing rapidly thanks to a string of acquisitions and was a darling of Wall Street. But behind the scenes, things were not as they seemed. Top executives, led by CEO Bernard Ebbers and CFO Scott Sullivan, were cooking the books to inflate the company's earnings and make it appear as though the company was performing better than it actually was. The fraud was executed by booking expenses as capital expenditures, which allowed Worldcom to artificially boost its profits and meet or exceed Wall Street earning expectations. This, in turn, kept the company's stock price artificially high and allowed executives to profit through insider trading, a practice which is illegal. And I'm sure you would think that they would get caught sooner rather than later, and so did I, but the fraud was so well concealed that it went undetected for years, until an internal auditor, Cynthia Cooper, stumbled upon the irregularities. Cooper and her team dug deeper and uncovered a massive accounting fraud, which ultimately led to the bankruptcy of the company and the loss of thousands of jobs. Much like the Enron scandal, this one resulted with many people on the streets, and the whole telecommunications industry took a hit. Not to mention, all of Wall Street took a hit. The revelation of the fraud sent shockwaves through the business world and led to increased scrutiny of corporate accounting practices. It also led to the conviction of top executives, including Ebbers and Sullivan, who were sentenced to 25 years and 5 years in prison, respectively. The Worldcom scandal serves as a cautionary tale of the consequences of greed and corruption. It also highlights the importance of corporate accountability and the need for oversight to protect investors and maintain the integrity of financial markets. The Worldcom scandal is not just a story of corporate greed and deception, but also is a story of resilience and determinations of a few individuals to uncover the truth and bring justice to the victims, to the people of our nations. Thank you so much for watching, and please subscribe. It really means a lot to us.